section, we're going to cover some terminology to help you understand some accounting terms. Let's take a look at the accounting equation. Assets equal liabilities plus equity. Assets are all items of value, both tangible and intangible. Cash, accounts receivable, inventory, furniture and fixtures, vehicles, equipment, and patents and goodwill. Liabilities are amounts that are owed and could include accounts payable, payroll tax payable, sales tax payable, notes payable, and mortgages. Equity is the amount of investment by owners and the accumulation of profits or losses. The difference between assets and liabilities is net worth. These are real accounts. They are permanent accounts that are not closed out at the end of a period, and the balances carry forward from one period to the next. If you hear someone talk about their balance sheet, these accounts are on the balance sheet, and we'll take a look at them later. Nominal accounts are temporary accounts that are closed out at the end of a period and start at zero for the beginning of the next period. Let's take a look at some nominal accounts. Revenue is another term for sales. Cost of goods sold, or COGS, is the cost of items purchased for resale or cost of manufacturing an item for resale. Expenses are all other costs of doing business, and you may hear them referred to as operating expenses. If someone asks about your income statement, profit and loss, or P&L, that's where you'll find these accounts. Your chart of accounts is a listing of a company's accounts and corresponding account numbers. Larger companies use numbering to help identify a division or department. On the right, you can see a sample of a few numbered accounts. The assets start with 1 and are listed in order of liquidity. Liabilities start with 2 and equity starts with 3. In most accounting software, you can select whether to include account numbers on your financial statements. Accounts receivable are sales on credit to your customers, and this is money owed to your business. Accounts payable are purchases you made from your vendors, and this is money your business owes to those vendors. Depreciation expense is a reduction in asset value based on IRS guidelines for age and use of the assets. A contra account is an account that carries the opposite balance of the normal account. Now, let's take a look at how debits and credits impact different account types. As you can see, the account types are listed on the left. So a debit increases an asset account, and a credit decreases an asset account. For the liability and equity account types, a debit decreases those, and a credit increases those accounts. For the income, a debit decreases and a credit increases. And then for expense accounts, a debit increases those and a credit decreases. Let's take a look at the accounting equation, assets equal liabilities plus equities. The normal balance for an asset account is a debit, and the normal balance for a liability account is a credit, and same with equity. We talked about numbering on the chart of accounts, and again, the asset account starts with a 1. I'm just going to use 4 digits here, but the numbers can be other links. Liability accounts start with a 2. And equity accounts start with a 3. And let's take a look at T accounts. Cash is an asset. And on the T account, the normal balance, or to increase the cash account, you're going to debit. For accounts receivable, to increase accounts receivable, that's also a debit. For the liabilities accounts, accounts payable, you're going to credit to increase it. And then notes payable, you're also going to credit to increase it. And for the equity, I'm going to put owner's equity on here. And to increase the owner's equity account, you would use a credit. Okay, now let's take a look at some journal entries for a business owner who's getting ready to open up a business. And then we'll transfer those journal entries to the general ledger, those T accounts that I mentioned earlier, so that you can see how the debits and credits are going to match. So let's start with January 1st. So we'll put that date in there. It would be whatever year that you were using when you started your business. And the owner put in $5,000 cash. So we need to make sure that we're debiting cash and that we're crediting owner's equity. And these journal entries are what go on behind the scenes in accounting software, but again, just so that you have an understanding of that double entry accounting. So the owner put in $5,000 in cash, so we're going to do the debit to cash for $5,000, and we're going to credit owner's equity for $5,000. And then on January 10th, the owner purchased some inventory, and the purchase was made with cash, so we're going to come down and we're going to say 110 for January 10th. We're going to put inventory here, and then we're going to put cash below it. And that purchase was $200, so we're going to debit inventory for $200, and we're going to credit cash for $200. Then on January 15th, the business owner purchased additional inventory, so we're going to put inventory here again. But they were able to get terms with this supplier, so that's going to go to accounts payable, and I'm just going to use that A/P to stand for accounts payable. They purchased $100 in inventory, so we're going to put that $100 debit to the inventory to increase that, and then we're going to put $100 credit to the accounts payable, showing that they still owe that money. And then on January 16th, the business owner decided they needed to purchase a piece of equipment. So equipment is an asset, so we're going to put that on the top line. And they used a loan or notes payable to purchase the equipment. And that purchase amount was $2,000. So we're going to debit equipment for $2,000, and we're going to credit notes payable for $2,000. Now let's take a look and see how these journal entries transfer over to the general ledger. I'm going to go ahead and label the accounts. The first account's the cash account. I'm just going to use the simplified numbers. So 1,000 for the cash account, 1,200 for the inventory account, 1,500 for the equipment account, then the next account is accounts payable, and I'm going to use the 2,000 because the liabilities start with 2. And then the notes payable, I'm going to use 2,500 and just put an NP there for notes payable. And then for the owner's equity, starts with a 3, so I'm going to put 3,000 and then just OE for owner's equity. So let's go back up and take a look at the first journal entry. That's $5,000, a debit for cash, and a credit for owner's equity. So we're going to go down and transfer this information into the general ledger. So $5,000 cash on 1/1, and then $5,000 owner's equity on 1/1. So we're going to go down here and credit owner's equity for $5,000. We'll go back up here, and if you were manually entering these, you would want to put a check mark here in the reference to let yourself know that you had already completed that so that you don't have duplicate entries, and then you have to go back and try to find what happened. So the next journal entry that we're going to transfer is that $200 inventory purchase that was purchased with cash. So we'll go down here to inventory. And that transaction was on 110. So we're going to say 110, and we're going to debit inventory. And then we're going to go over, since it was a cash purchase, and we're going to credit cash. So we're reducing the cash amount because we paid that cash out. I'm going to go back up and check mark those so that I know that I've done them. The next entry here is inventory purchased on credit or on account, so that goes to accounts payable. So we're going to debit inventory for $100, and then we're going to credit accounts payable for $100. So we're back down here at the inventory, and the date's 1/15. We're debiting inventory for $100, and then that $100 worth of inventory was purchased on account, so we're going to go down and credit accounts payable. Again, coming back up and check marking those off. The last entry that we have on here is the purchase of equipment using a loan or note payable for $2,000, and that was on 1/16. So we're going to go down to equipment, and we're going to debit equipment for $2,000. That equipment was purchased with a loan or note payable, so we're going to credit notes payable for $2,000. That's a quick look at the behind the scenes journal entries, and then transfer to that general journal to generate the business reports. Now let's take a look at the accounts that impact your income statement or your profit and loss. Remember that the revenue and expense accounts are nominal accounts, so that means that they are temporary accounts. I'm going to go ahead and bring this revenue down, and revenue is any income that you generate from the sale of products or services for your business. And then in that expense category includes COGS, or the cost of goods sold, and also operating expenses. And the revenue less the cost of goods sold and the operating expenses is equal to that profit or loss for your business. And that profit or loss transfers over to the equity on the balance sheet. Now, when we're looking at the different accounts here, revenue is a $4,000 account. The COGS, or cost of goods sold, starts with a 5, so I'm going to put 5,000 there. And then the expenses, I'm just going to put an expenses account here just to show you, start with 6, so I'm going to put 6,000 here. To increase the revenue account, you need to credit it. To increase the COGS account, or cost of goods sold, you need to debit. And then to increase the expenses accounts, you need to debit. Let's take a look at how all of this comes in to the balance sheet. So you see the accounting equation, assets equals liabilities plus equities, the information that goes on your balance sheet. The normal account balances for the asset is a debit. The liabilities and equities are both credits. And then remember, if you're using a numbering system, it always starts with 1 for assets, 2 for liabilities, 3 for equity. And then as we move down here, we have the revenue and expense. The revenue starts with 4 if you're numbering, and the expenses start with 6. And I'm going to go ahead and add a COGS right down here, and that starts with 5. The normal balance to increase the revenue is that credit. Normal balance to increase the expense is the debit. Now you do have other revenue accounts potentially. So revenue generated that isn't part of your daily business operations. And that would start with a 7 when you're numbering those, and then other expenses. Those would start with an 8. And the normal balance for the other revenue account is going to be a credit, and the normal balance for the other expenses account is going to be a debit. You do have contra accounts. And accumulated depreciation. It is one of those, it's an asset account, but it has a credit balance. Now let's take a look at some journal entries for daily business activities. So we worked on journal entries earlier that impacted the balance sheet accounts. Now the business owner has the equipment in, they've got some inventory, they're ready to start selling. And on January 20th, so I'm just gonna put the 120 here, they make a product sale of $300 and they receive cash for that. So what we're going to do is we're going to come in here, we're going to add cash right here, and right below that, I'm just going to put in product sale. This could be whatever account, if you had different income accounts that you named it where you could track and follow. And that was for $300. So we're going to debit cash for $300, and then we're going to credit product sale for $300. Along with that, and that's the nice thing about accounting systems behind the scenes, that they handle all of this stuff, we're also going to do a cost, and I'm going to put COGS here, but it's cost of goods sold, was $100. And then we're going to reduce the inventory because the business owner sold some products. We're going to reduce the inventory by $100. So 2 parts to that cash transaction when you're carrying inventory. Now we go a couple days later in the week on January 22nd, and the business owner sells another product, but sells it on credit or gives the customer terms. I've got AR here, and that stands for accounts receivable. And then product sale is that revenue or income account. Sold another unit, so I'm going to put $300 debit for accounts receivable, and then a $300 credit for product sale. Again, you also have to do that cost of goods sold. So I'm going to do the COGS down here, and then I'm going to do the inventory to adjust that. That's a debit to COGS for $100 and a credit to inventory for $100. Now the business owner has to pay rent. On January 25th, so I'm going to put rent expense. And then they're paying that with a check or cash. So I'm going to put cash below, and that is $500. So we're going to debit the rent expense for $500, and we're going to credit cash for $500 to reduce the cash amount to show that it is going out of the business. And then at the end of the month, on the 31st, payroll comes due. So I'm going to put payroll expense, and then cash, and that's $250. So we're going to debit payroll expense for $250, and we're going to credit cash for $250. Now we're going to go down and take a look at the T accounts like we did before with the balance sheet. And I'm going to add accounts receivable. And I'm going to number that 1100. And then I'm going to move to the product sales. I'm going to number that 4,000. Then the COGS, or that cost of goods sold, I'm going to number 5,000. The rent expense, just going to put in at 6,000. And then the payroll expense, I'm just going to use 6,100 for that. Now let's go up and take a look at the journal entries and transfer the journal entries to the general ledger. So on 1/20, the business owner received $300 in cash and sold $300 worth of product. So we're going to go down to the general ledger and we're going to put 120. We're going to credit product sales for $300. And then we're going to go up to what we had worked on before with the T accounts to cash. And we're going to debit cash on 120 for $300. Again, I always recommend if you're doing anything by hand to make a star, a check mark, something to note that you have already taken care of that if you're transferring information. If you're using an accounting system, all of that's taken care of behind the scenes once you categorize the information appropriately. So the second part of that entry is a debit to COGS for $100 and a credit to inventory for $100. So I'm going to scroll down to COGS. And I'm going to put the date in there, 1/20, and then I'm going to debit COGS for the $100. Now I'm going to go back up to the inventory, put the date in there of 1/20, and I'm going to credit inventory for $100. Come back in here, check mark those off because I've completed that. Now the business owner sold additional product and they extended terms to their customer, so that's why they've got the accounts receivable on there. So we're going to debit accounts receivable and we're going to credit product sale for $300. So we're going to come down here, put in the date, and then we're going to debit accounts receivable, and then we're going to come over to product sales, put in the date, and we're going to credit the product sales. So we've got the first part of that taken care of. Now we have to do that COGS where we debit for $100 and then we credit inventory for $100. So I'm going to go down and put in the date, debit COGS for $100. Go ahead and put a check mark in there, and then now I'm going to go up and I'm going to credit inventory for $100. And the date on that was the 22nd. Check mark there to note that that's been taken care of. The business owner had to pay rent on the 25th, so we're going to debit rent expense for $500 and then we're going to credit cash for $500. So rent expenses down below, we're going to debit that for $500. And then we're going to go up to our cash account and we're going to credit our cash account for $500 because that is money going out of the business. Come back down here to our journal entries. Again, mark those so that we know that's been completed. And then the last journal entry on here is for payroll expense. So we're going to debit payroll expense for $250 and we're going to credit cash for $250. So on 131, we're going to debit payroll expense for $250. Then we're going to go back up to our cash account and we're going to credit the cash account for $250. Come back down, and make sure that those are checked off. That's just a high-level overview of some typical journal entries and then how those transfer to the general ledger.